You see it, the perfect trading setup. Everything aligns beautifully. The trend is crystal clear. The support level is obvious. The indicators are all confirming. This is the trade you've been waiting for all week. Your heart starts beating faster. This is it. This is the one. You can feel it. Every part of your trading knowledge tells you this setup is golden. This is a textbook entry. This is what professional trading looks like. You entered the trade with absolute confidence. You're not guessing, you're not hoping, you know this trade will work. You've seen this pattern 100 times in your back tests. You studied this exact scenario. This trade has everything. And that confidence feels good, really good. You're finally trading like a pro. You're reading the market correctly. You're seeing what others might miss. This is why you became a trader, for moments like this. But then, something strange happens. The trade moves against you. Just a little bit at first, nothing major, just a small pullback. But it shouldn't be pulling back. This is a perfect setup. Perfect setups don't pull back like this. You start watching more closely. Your hands tense up. Your breathing gets shallow. That confidence you felt minutes ago starts turning into something else. Doubt creeps in. Wait, did I miss something? Is this actually not the setup I thought it was? The price moves against you a bit more. Now you're really worried. You start second-guessing everything. Maybe the trend isn't as strong as you thought. Maybe that support level isn't as solid. Maybe you read the whole thing wrong. Your perfect setup, the one you were so confident about, suddenly feels like a mistake. And because you were so confident, because you were so sure, the doubt hits you twice as hard. You exit the trade early, taking a small loss, convinced you were wrong. 10 minutes later, the price reverses exactly as your original analysis predicted. The trade goes on to hit your profit target perfectly. You were right all along, but you're not in the trade anymore. You exited because your confidence turned into doubt the moment the trade didn't move perfectly. This is the mental trap that ruins your best setups, and it happens to traders every single day. It's not about lack of knowledge. It's not about bad strategy. It's about psychology, trading psychology. Let me tell you about Yale, who destroyed his best trading opportunities for months before he understood what was really happening. Yale had been trading for about 14 months when he noticed something disturbing in his trading journal. His best setups, the ones he was most confident about, had the worst results. Not because the setups were bad, but because Yale kept exiting them early. His mediocre setups, the ones he took with mild confidence, performed much better. Yale would enter these trades thinking, "This might work, let's see," and he'd let them play out naturally. Many of them hit his profit targets because Yale wasn't obsessively watching them. But his perfect setups, the ones where Yale thought this is definitely going to work, those trades Yale watched like a hawk. Every tiny movement against him felt wrong. Every small pullback felt like the trade failing. And Yale would exit early, often right before the trade would have worked perfectly. Over 3 months, Yale identified 23 trades he considered perfect setups. He was highly confident about all 23. Guess how many of those 23 trades actually reached his profit target? 0, because Yale exited all 23 early. But here's what made Yale feel sick. When he reviewed those 23 trades, 19 of them would have hit his profit target if he just held them. 19 out of 23. That's an 83% success rate. But Yale's actual success rate on those trades was 0%. Because he exited them all prematurely. Yale calculated the cost. Those 19 trades that would have worked represented $7,600 in missed profits. Yale had turned a potential $7,600 gain into a series of small losses and break-even exits because he couldn't handle the psychological pressure of being in trades he felt confident about. This made no sense to Yale at first. Why would confidence hurt his trading? Isn't confidence good? Aren't you supposed to be confident in your trades? Every trading book talks about the importance of confidence. But Yale's confidence was poisoning his best opportunities, and he needed to understand why. Yale's confusion about why confidence hurt his trading led him to research the psychology behind it, and what he discovered explained everything about his pattern. The problem wasn't confidence itself. The problem was what happens psychologically when you're highly confident and reality doesn't immediately match your expectations. When you take a trade with high confidence, your brain creates a very specific expectation of how that trade should behave. You expect it to move in your direction immediately. You expect it to move smoothly. You expect it to prove you right quickly. This expectation becomes rigid. Your brain isn't flexible about it. You're not thinking, this trade might work eventually. You're thinking, this trade should work right now. So when the trade pulls back, even slightly, your brain experiences something called expectation violation. What's happening doesn't match what you expected to happen. An expectation violation triggers stress. Your brain interprets the pullback as evidence that you were wrong. Not, this is normal price movement within a winning trade, but this trade is failing. I made a mistake. I need to get out. The more confident you were, the stronger the expectation, and the worse the expectation violation feels. A trader who enters with mild confidence can handle pullbacks easily because they didn't expect perfection. But a trader who enters with high confidence can't handle any deviation from their expected outcome. Yale experienced this constantly. When he took a perfect setup, he expected it to work immediately and perfectly. Any pullback felt like failure. His confidence made him inflexible and reactive. But there's another layer to this psychology. High confidence also increases what psychologists call ego involvement. When you're highly confident, your ego becomes attached to the trade being right. The trade isn't just a trade anymore. It's proof of your intelligence, your skill, your ability to read markets. So when the trade pulls back, it's not just the trade that's threatened. Your self-image is threatened. You're not just losing money, you're being proven wrong. You're looking stupid. Your ego can't handle it. This is why Yale exited his perfect setups early. His ego was so invested in being right that any sign of being wrong triggered an emergency response. Exit now. Protect the ego. Don't let this trade prove you're not as good as you think you are. Yale realized that his confidence was creating a mental trap. He was so sure these trades would work that he couldn't handle the normal volatility that occurs in every trade. His certainty made him fragile instead of strong. Understanding how confidence created fragility was important, but Yale noticed another psychological pattern that made the mental trap even worse. He was constantly comparing his actual trades to his imagined perfect trades. In Yale's mind, before entering a perfect setup, he would visualize how the trade should go. Price enters, moves steadily in his direction, maybe one small pullback that respects support, then continues to profit target. Clean, smooth, profitable. This mental image became the standard, and when reality didn't match this image, Yale felt like the trade was failing even when it was actually working fine. Yale would enter a trade and price would chop around for a while. Perfectly normal behavior. But in Yale's mind, the perfect version of this trade wouldn't chop. It would move cleanly. So the chopping felt wrong. It felt like the trade was broken. Or Yale would enter and price would pull back more than he expected. Still within normal volatility, still respecting key levels. But in Yale's mental image, the pullback should have been smaller. So this larger pullback felt like evidence the trade was failing. Yale was comparing his real trades to impossible standards.
Real market behavior never matches perfect mental images. Markets are messy, price moves are jagged, pullbacks happen, consolidation happens. Even winning trades look ugly sometimes. But because Yale was comparing reality to perfection, reality always felt disappointing. And that disappointment made him exit trades that were actually working fine. This comparison trap is especially dangerous in trading psychology because you can't see the future. You don't know if the current pullback is temporary or the start of a reversal. You don't know if the choppy price action will resolve upward or downward. So your brain looks for clues. And if the trade doesn't match your perfect mental image, your brain interprets that as a clue that the trade is failing, even though it's not a reliable clue at all. Yale also noticed that he only made these comparisons on his confident trades. On trades he felt uncertain about, he didn't have a perfect mental image. He'd think, well, let's see what happens. And he'd let the trade play out without comparing it to anything. But on perfect setups, Yale had vivid mental images of how things should go. And those images became mental traps that made him exit winners early. Yale's realization about comparing reality to mental images led him to notice an even deeper psychological pressure. The more confident he was, the more pressure he felt to be proven right quickly. When Yale took a trade with high confidence, he needed validation. He needed the market to confirm he was right, not eventually, right now, immediately. Every minute the trade didn't move in his favor felt like torture. Yale would sit there watching the price, waiting for it to prove him right. His whole body was tense. His eyes were locked on the screen. He was barely breathing. This pressure was exhausting, and the longer the trade took to move, the more unbearable the pressure became. Eventually, Yale would exit just to escape the pressure, not because the trade was actually failing, but because he couldn't handle the psychological stress of waiting to be proven right. Yale realized this pressure didn't exist on his low-confidence trades. On those trades, he'd enter and think, we'll see how this goes. He didn't need immediate validation. He was okay with waiting. He was okay with uncertainty. But high confidence created a need for immediate certainty, and markets rarely provide immediate certainty. So the pressure built until Yale couldn't take it anymore. This pressure also made Yale overtrade in a specific way. After exiting a confident trade early, Yale would feel terrible. He just exited what he believed was a perfect setup. He'd feel like he made a mistake. His ego would be bruised. So Yale would look for another perfect setup to redeem himself, to prove he could be right, to restore his confidence. And he'd enter that new trade with even more confidence and even more pressure to be right immediately. This created a cycle. Confident trade, pressure, early exit, bruised ego, new confident trade, more pressure, early exit, worse bruised ego. The cycle continued until Yale was emotionally exhausted and his account had suffered from all the missed opportunities. The trading psychology at work here is fascinating. You'd think confidence would make trading easier. But Yale discovered that excessive confidence made trading harder. It created pressure that didn't need to exist. It created standards that couldn't be met. It created fragility instead of strength.
Yale's struggle with confidence led him to question what real confidence in trading actually means, and the answer completely changed his approach. Yale realized he'd been confusing certainty with confidence. When he felt confident about a trade, what he really felt was certain. Certain the trade would work, certain about the outcome, certain he was right. But certainty is incompatible with good trading, because trading is probabilistic. No trade is certain. Every trade might win or might lose. Even perfect setups fail sometimes. That's the nature of trading. Real confidence isn't being certain about outcomes. Real confidence is being certain about your process. It's knowing that if you execute your strategy correctly over many trades, you'll be profitable overall, even if this specific trade loses. This distinction changed everything for Yale. Before, he'd look at a perfect setup and think, this trade will definitely win. That's certainty, and it created all the psychological problems Yale experienced.
After understanding real confidence, Yale would look at a perfect setup and think, this is a high probability setup according to my strategy. It might win or might lose, but taking this trade is correct process. Same setup, completely different psychology. The first mindset created pressure, expectations, and fragility. The second mindset created calmness, flexibility, and resilience. With the second mindset, when the trade pulled back, Yale didn't panic. He'd think, pullbacks are normal. This doesn't mean the trade is failing. I'll let my original plan play out. With the second mindset, Yale wasn't comparing reality to a perfect mental image. He wasn't expecting smooth, clean price movement. He was just expecting his edge to play out over time across many trades. Yale also learned to separate his identity from individual trades. Before, being right about a trade meant he was smart, skilled, and valuable. Being wrong meant he was dumb and bad at trading. After, each trade was just data. A win meant this outcome was one of the expected winning trades in his strategy's probability distribution. A loss meant this outcome was one of the expected losing trades. Neither said anything about Yale as a person. This shift from certainty to true confidence, from outcome-focused to process-focused, from identity-attached to data-oriented, changed how Yale experienced trading. Perfect setups stopped feeling like high-pressure moments. They became just another opportunity to execute his process correctly. Understanding what real confidence meant was crucial, but Yale still needed practical ways to execute trades without falling into the mental trap, and he developed a specific system. Yale called his system detached execution. The goal was to execute perfect setups without the psychological baggage that ruined them. Here's what Yale did. Step 1. Remove outcome expectations. Before entering any trade, Yale would say out loud, "This trade might win or might lose. Both outcomes are acceptable. My job is to execute my process, not to control the outcome." This verbal reminder helped Yale's brain release attachment to specific outcomes. It broke the certainty mindset before it could form. Step 2. Pre-commit to the plan. Yale would write down his entry, stop loss, and profit target before entering the trade. He'd commit to these levels when his mind was clear and analytical, not after entering when emotions could influence him. Then Yale would tell himself, "These are my levels. I will not change them unless the market structure changes significantly. Small pullbacks and chop are expected and will not cause me to deviate." This pre-commitment removed the in-the-moment decision-making that led to early exits. Step 3. Close the platform. After entering the trade, Yale would close his trading platform, not minimize it, close it completely. He'd set alerts when price approached his stop loss or profit target, but otherwise he wouldn't watch the trade. This was the hardest part for Yale, especially on perfect setups. His brain wanted to watch, wanted to see if he was being proven right. But watching created the psychological pressure that ruined trades. By closing the platform, Yale removed the ability to react emotionally to normal price movement. He couldn't exit early if he couldn't see the price moving. Step 4. Schedule check-ins. Instead of constantly watching, Yale would check his trades at scheduled times. Every 2 hours, he'd open his platform, look at his positions, verify they hadn't hit stop loss or target, then close the platform again. These scheduled check-ins gave Yale just enough monitoring to feel comfortable without the constant watching that created problems. Step 5. Journal without judgment. After each trade closed, Yale would journal it, but he changed how he journaled. Before, he'd write things like, "I was right about this setup," or "I should have trusted my analysis." Now, Yale would write, "This trade followed my process. The outcome was win or loss. This is one data point in my overall strategy. No single trade determines anything." This journaling style reinforced detachment from outcomes and focus on process. These 5 steps transformed how Yale traded perfect setups. Within 2 weeks of implementing detached execution, Yale's success rate on high-confidence trades jumped from 0% because he exited them all early to 74%. That 74% wasn't better than the 83% success rate the trades would have had if he'd just held them blindly, but it was dramatically better than the 0% he was getting before. And Yale was actually capturing most of the gains from his best setups instead of exiting them prematurely.
Yale's journey from confidence-ruined trading to detached execution revealed what real trading psychology success looks like, and it's different from what most people teach. Most trading psychology advice focuses on building confidence. Believe in yourself, trust your analysis, have confidence in your trades. But Yale learned this advice is backwards. The best trading mindset isn't high confidence, it's comfortable uncertainty. It's being okay with not knowing what will happen. It's executing your process without needing the market to validate you immediately or ever. Professional traders aren't confident about individual trades. They're confident about their edge across many trades. They can take a perfect setup and remain emotionally neutral about whether this specific trade wins or loses. This mindset shift is difficult because it goes against natural human psychology. Humans want certainty. We want to know we're right. We want validation. We want our beliefs confirmed. But trading requires accepting that you can't have certainty. You can have a high probability setup, but high probability isn't certainty. Even 80% probability means 20% of trades will lose. And you can't know which trades are in the 80% and which are in the 20% until after they close. Yale also learned that the best trading psychology involves separating your identity from your trading results. When your identity is tied to being a good trader or being right about markets, every losing trade threatens your identity. Every losing streak makes you question yourself. But when your identity is separate, you're a person who trades using a specific process. Losses don't threaten who you are. They're just data points in a probabilistic game. This doesn't mean not caring about results. Yale cared deeply about his overall profitability, but he stopped caring about individual trade results as measures of his worth or skill. Yale's transformation from someone who ruined perfect setups to someone who executed them detached and profitably offers clear steps you can take right now to escape the mental trap. First, recognize the trap in your own trading. Review your recent trades. Do you exit your high-confidence trades early? Do you handle uncertainty better on trades you're less sure about? If yes, you're in the mental trap. Second, understand that confidence about outcomes is your enemy. Stop trying to be certain about individual trades. Start being certain about your process instead. This mental shift is fundamental. Third, implement detached execution. Use Yale's 5-step system. Remove outcome expectations. Pre-commit to plans. Close the platform after entering. Schedule check-ins and journal without judgment. Fourth, practice comfortable uncertainty. Before entering trades, especially perfect setups, remind yourself, I don't know if this specific trade will win. I only know that executing my process correctly will lead to long-term profitability. Fifth, separate your identity from your trading. You are not your trading results. You're a person executing a trading process. Good trades can lose. Bad trades can win. Outcomes don't define you. The mental trap that ruins your best setups is real. It's rooted in deep trading psychology. It happens when confidence becomes certainty, when ego becomes attached to outcomes, when you need immediate validation from the market. But the trap is escapable, not by becoming less confident, but by channeling your confidence into your process rather than into specific outcomes. Not by caring less, but by caring about the right things, execution, consistency, process, rather than the wrong things, being right, being validated, being certain. Yale spent months ruining his best trading opportunities before he understood this. You don't have to. You now understand the mental trap. You know how it works.
You know how to escape it. The question is, will you recognize it in your own trading? Will you implement detached execution? Will you shift from certainty to comfortable uncertainty? Your best setups are waiting. They're there in the market. Your strategy can find them. But they'll only be profitable if you can execute them without falling into the mental trap that turns perfect setups into premature exits and missed opportunities.